Hello, I'm Gary Tillis, and the topic I'm going to be speaking on is deciding on a form of business entry. Businesses can take on many forms, but the most common are sole proprietorships and partnerships, limited liability companies, and C corporations and S corporations. Let's start with a sole proprietorship. A sole proprietorship is owned by a single individual, and as a sole proprietor, you're primarily responsible for the liabilities of your business. In addition, you are also responsible for the liabilities incurred as a result of legal action brought towards your company. Basically, you can think of a sole proprietorship as being an extension of yourself. Forming a sole proprietorship takes relatively no effort. The second you engage in an activity with the goal being to generate a profit, you're considered a sole proprietor. Sole proprietorships are also classified as flow-through entities for tax purposes. Now, you might be wondering what a flow-through entity is. As a flow-through entity, your business is not responsible for paying taxes on income. Rather, the income flows through the business and onto the individual owner, who is then responsible for paying the tax on said income. The same cannot be said for corporations like Procter & Gamble, General Motors, who pay taxes on income at the entity level, but we'll get to that later. One of the issues you'll have to consider when deciding on a form of business is how much capital does my business require. As a sole proprietor, access to capital is very limited, and turning to a bank for a loan is often quite difficult when first starting out. Now, in an effort to be simple, from now on, anytime I refer to access to capital, I'm generally referring to capital that can be generated without issuing debt. As a sole proprietor, you'll have complete control of how the business is operated. For many entrepreneurs, this can be a critical factor if they have a specific vision for what they want the business to become. On the other end, the biggest disadvantage of being a sole proprietor is that you alone will be responsible for the liabilities of the business, whether financial or legal. Now, moving on to partnerships. For the most part, sole proprietorships and partnerships are very similar. The difference being that in a partnership, the business is owned by two or more people. Much like a sole proprietorship, the individual partners are responsible for the liabilities the business incurs, except in the case of limited partners. Tax classification as a partnership is the same as a sole proprietorship. Forming a partnership is almost as simple as forming a sole proprietorship, and most of it depends on the type of partnership being formed. As a general partnership, formation can be accomplished through a partnership agreement or an oral agreement. However, partnership agreements are always a good idea, as they can help avoid disputes between partners later on in the business cycle. On the other hand, we also have limited partnerships. This type of formation requires filing a certificate of limited partnership within the state you plan on doing business. Here's an example of a certificate of limited partnership. As you can see, forming a limited partnership is a little bit more complex than forming a sole proprietorship or general partnership, but not by much. This option should be considered if one partner's primary purpose is to provide financial backing for the business. In that situation, the partner financing the venture may not have substantial managerial responsibilities. In that case, being a limited partner in a partnership is something you should consider. Now, as a partnership, access to capital is very similar to sole proprietorship. It's generally limited to what partners can raise without considering issuing debt. Sole proprietors can also form a partnership with a limited partner and still retain substantial control as a managing partner. This can take care of the issue of disputes between partners. Now, as a partnership, one of the biggest advantages is that you have a shared financial commitment between the partners. You are not out on your own. Liability is somewhat spread out, although if your partners cannot take care of paying off that liability, you're generally going to be solely responsible, with the exception being a limited partner and a limited partnership. Now, on the other end of the spectrum, the biggest disadvantage of a partnership is disputes among partners. If you're going to make a financial commitment and take a risk on forming your own business, you need to make sure your partner is somebody you can rely on. Someone that's dependable. Someone that's going to work in the best interest of the business. And most importantly, somebody that has the same vision as you. Moving on to LLCs, or limited liability companies. With an LLC, responsibility of liabilities is not designated to the individuals owning the business. As an LLC, liabilities will be designated to the business itself. LLCs are also classified as flow-through entities. You can think of an LLC as a hybrid between a sole proprietorship and a corporation, because much like a sole proprietorship or a partnership, income flows through the business and is taxed at the individual level, while at the same time you cannot be held personally responsible for the liabilities incurred by the business, just like a corporation. However, forming an LLC is more complex. When forming an LLC, one of the first things you have to do is choose a business name. There's 3 things you have to consider when making this choice. First, the name must be different from an existing LLC in your state. It must indicate that it is an LLC, such as Tillis & Company, LLC, and it cannot include words restricted by your state. The next thing you have to do is file articles of organization with your state. Information and articles of organization include your business name, address of business, and the names of the members. While operating agreements aren't required by most states, it should really be considered for multi-member LLCs. Much like a partnership, if you don't have some type of agreement, you're going to run into disputes between members. And the most important things you need to consider are licenses and permits for the industry you're in. In addition, some states do require that LLCs publish a statement in their local newspaper about its formation. Much like a partnership, access to capital depends on the number of members and what those members can generate. The biggest advantage of an LLC, you have limited liability. The biggest disadvantage of an LLC, it has a limited life. Just like with a sole proprietorship or a partnership, if a member passes away, decides they no longer want to be a part of the company is in effect dissolved, and you'll have to form a new company and put forth a new set of articles of operation. Moving on to corporations. Corporations are probably the most talked about form of business in the media. As a C corporation, responsibility of liabilities is designated to the business itself, just like an LLC. However, unlike the 3 forms of business we've already discussed, a C corporation is not classified as a flow-through entity. It's classified as a separate tax-paying entity, and this is where double taxation comes into play. As a separate tax-paying entity, a corporation is going to incur taxes on 2 levels. First, the business itself is going to pay taxes on its share of taxable income. At the second level, shareholders are going to have to pay taxes on the after-tax earnings distributed by the business. This is what I'm referring to when I say double taxation. Now at the shareholder level, after-tax earnings are typically distributed in the form of a dividend. But dividends are not going to be taxed at the entity's marginal rate. It's going to be taxed as a capital gain, and the capital gains tax is typically 15%. Also, as a C corporation, forming the company is substantially more complex than forming an LLC. When forming a C corporation, you're going to incur costly administrative fees. In addition, there's complex tax and legal requirements that have to be fulfilled. C corporations must also use the accrual method for accounting. While I'm not going to go into the specifics, there's also public corporations, which must follow accounting rules known as generally accepted accounting principles, and also must be audited by independent organizations. As a C corporation, generating capital is going to be relatively easy. As a C corporation, or any other type of corporation, you can generate capital through the sale of stock. This can be accomplished at the private level or the public level. This is also one of the biggest advantages of forming a C corporation. While the biggest disadvantage is obviously the issue of double taxation. Moving on to S corporations. Now, before I go over what an S corporation is and how it works, I'm going to pass the conversation off to Scott Estel to explain the biggest difference between an S and C corporation.
Many small businesses are looking at different entity choices and have come down to the decision that they want to do a corporation. And like most tax things, this is not necessarily a simple decision because you have two choices here. You have what's called a C corporation and you have what's called an S corporation. And there's really no difference between the two business entities as far as asset protection goes, probably not as far as estate planning goes, but there's a huge difference as far as the taxation goes. And basically, a C corporation is going to be like the publicly traded companies you see on Wall Street. So you may see Microsoft or Intel or IBM or United Airlines or any of these big companies are C corporations. And what that means is that whatever income they have, they're taxed at the corporate level. For a lot of small businesses, they don't want to be taxed at the corporate level, and so they want to be taxed only at the owner level or the shareholder level, and that's why they would make the S election. So basically the difference between a C Corp and an S Corp is where you want the profits or the losses to go to be taxed. Do they stay with the business? That way you get a C Corp, or do they go with the owners, the shareholders? That way you get an S Corp.
Just like an LLC or a C corporation, responsibility of the liabilities is also designated to the business, just like Scott said. However, it's not classified as a separate tax-paying entity. It's classified as a flow-through entity, just like sole proprietorships, partnerships, and LLCs. However, being an S corporation as a flow-through entity gives you the advantage of issuing stock in order to raise capital. But forming an S Corp is more complex than LLCs and C corporations, and here's why. Now, forming an S corporation is initially similar as forming an LLC. There's very similar requirements in the beginning. However, requirements also include owner restrictions, stricter operational processes, and shareholder compensation requirements. As an S corporation, you cannot have more than 100 owners. Corporate and partnership shareholders are also forbidden. In addition, unlike a C corporation, owners have to be residents of the United States. As an S corporation, you're also required to have scheduled director and shareholder meetings. In addition to these meetings, you have to maintain records of the minutes from these meetings, the adoption and updates to the bylaws, and stock transfers. Shareholder compensation requirements are also included. Now, this is a very simplistic, generalized statement, but shareholders must receive reasonable compensation if they are actively managing the company. There's also factors that come into play if you are a passive shareholder. Now, I'm not going to get into the complexities of all the requirements of S corporations, but they're vast. And just like a C corporation, S corporation's access to capital is high, not as high as a C corporation, due to the exception of owner restrictions. Biggest disadvantage of S corporation? There's many rules, as I've already showed you. That's a very small portion of all the regulations and requirements you have to follow as an S corporation. I didn't include this throughout the entire presentation, but this can be a helpful aid on when deciding between different forms of organization. And when going through this chart, you should really consider 3 questions. How much control do you want over the business? What is your risk tolerance? In other words, how much liability are you willing to take on? And what resources do you require? As in, how much capital do you need to generate to form this business? I interviewed a man named Steve Dill. He's an entrepreneur and really does fit the definition of what an entrepreneur is. He's the former owner and operator of Dill's Restaurant and a Dairy Queen franchise. Mr. Dill purchased Dill's Restaurant from his father in 1974. In doing so, he decided to operate the business as a sole proprietor. Mr. Dill believes that 100% control of your business is necessary, and to be honest, he said he did not really think about other forms of entry. So when I said being a sole proprietor is the easiest form, I really mean it. You literally do not even have to think about it. Later on, he sold the business to a family member in 1992. He then went on to purchase a Dairy Queen franchise in 1992 from the former owner. When doing so, he decided to become an S corporation. He remained the only shareholder in the company, sticking to his principle of 100% control, and sought less risk, and the S selection substantially limited his liability financially and legally. Ultimately, his decision over an LLC was suggested by his accountant. This concludes our topic of deciding on a form of business entry.